exciting webinar planned. Make sure that everyone can see my screen. And so this is part of our best practice series, and we have a monthly webinar that we try to identify topics that are relevant to privately held businesses and also topics that are timely in the business calendar. So with that, I'm going to start in on understanding taxes. These are designed for business owners where we know the business owner has a short window of time generally, and we appreciate you spending the next 30 minutes with us. So with that, legal disclaimer, we did our best to prepare accurate information, and we're going to present it accordingly. You're welcome to use it, but just let us know if you're gonna use it. Thank you. And a little bit about us. We consider ourselves your partner without equity. We're passionate about helping clients build businesses and net worth that support them in their fulfilling lives. And we have clients at all stages, startup to very mature businesses. And we also help the owner sell a business down the road or acquire a business. Worthwhile plans take time to realize. We work together with our clients to create plans that fit them. Today, we're going to start out with who needs to file Form 1040. We're going to look at how you read a 1040. Then we're going to look at the different types of income. Then we're going to look at what's included in your total income. And we're going to look at the difference between marginal and effective tax rates. Then we're going to have some fun and some question and answer time. So we've got quite a bit to get through. So I'm going to move quickly so we have time for the fun and the questions and answers at the end. So who needs to file? This slide is organized like the filing statuses: single, married filing joint, and married filing separate, head of household. And, essentially how you read this is, in the case of a single, if income is less than 14,600, there's not a filing requirement. If the filer is over 65, that moves up to $16,550. In the case of dependents, if they have unearned income of more than $1,300, they're required to file. If the income is earned, that moves up to $14,600. Now, there might be instances where your dependent isn't required to file. However, it isn't necessarily a bad idea not to file, because down the road they may need a loan or what have you, and the bank or the lender would want to see those tax returns. And it's a good thing, I think. This is probably a familiar sight to you all. This is the top part of page 1 of Form 1040, where you identify your filing status. This has been around for a while, since 2022, but the IRS wants to know if you've got digital assets. And you're required to check either yes or no. Now on to the different types of income. These, as you'll see later on, these drive the income tax rates and what taxes you're paying. So reading, taking the left column, we start out with active income. This is income that you earn. This is income that is derived from essentially your job, whatever that is. And your efforts influence how much income you make or earn. The different types of tax that income is subject to include Social Security and Medicare tax, federal income tax, state income tax. It, however, does not include or is not subject to capital gain tax. Moving on to the right column, passive income is earned from your investments. You don't need to work to earn this income. And in many cases, the market influences how much income you earn or don't earn. This income is not subject to Social Security and Medicare tax. And in the case of selling an investment, it is subject to capital gain tax. However, as we'll see, in some cases, it can also be subject to similar tax rates as active income. Now, looking at a little further down on page 1 of the 1040, we see that there's a separate line for W-2 income. This would be active income. And then moving on down to lines 2 and 3, this would be this would be income from investments, and these can actually, in this case, dividends can be subject, depending on the type of dividend, it can be subject to a capital gain tax rates. And in the case of interest, that's subject to ordinary rates. Same thing goes for retirement income from IRA distributions, pensions. And then in the case of Social Security benefits, depending on how much income you have, determines what portion, if any, of the Social Security benefits are taxable. And then we've got line 7 for your capital gains and losses. And line 9 is your total income. So speaking of Social Security, if you're single and your combined income is less than 25,000, Social Security benefits are not taxable. If it's between 25,000 and 34,000, it's up to 50% is taxed. And then over 34,000, up to 85% of Social Security is taxed. And you can see for the different statuses what those differences are. Now, in this section, we're looking at adjustments to income, which is line 10. And these would be, in some cases, driven from a W-2. In the case of a business owner, in order for the health insurance on their health insurance and their family's health insurance, or health insurance attributed to any related parties to them that the company pays, in order for that to be deductible, it needs to get added to their W-2. And then it's an adjustment to offset that. So there's some nuances to that in order to come up with one's adjusted gross income. Another adjustment not necessarily for a business owner, might be HSA contributions that are not made by an employer. So if you're making those on your own, that would be another example of an adjustment. So they're valuable. They reduce your adjusted gross income and ultimately your taxable income. Depending on how much you have in itemized deductions is going to determine whether you take the standard deduction or an itemized deduction. And after those deductions, you've got your taxable income. So before we move on from this, let's go back to the W-2. This can be a pretty complex document or tax form, depending on what kind of benefits the employer has available. So in the case of retirement, the regular deferrals into a 401k are subject to Social Security and Medicare. However, they're not subject to federal and state income tax because you're deferring that income as an employee into your retirement account. If the deferral is into a Roth 401k, that Roth is subject to income tax, and that would be included. In my adjustment example for a business owner with health would get added to box 1 wages and subject to federal and state income tax, but for the adjustment that is in the same dollar amount. So it doesn't, you get to take that deduction in that case. And this is a summary of a tax return that we prepared. And on our summaries, we provide a marginal tax rate and then an effective tax rate. So one way to think of the marginal rates, and we'll look at the marginal rates for 2025, but basically the more you make, the more you pay, and you'll see that. And there's separate rates for single status, married filing joint, etc. In the case of the effective tax rate, that is essentially, what you're paying in tax, divided by your taxable income. So speaking of the marginal rates, what we're looking at on the screen are the marginal rates for 2025. And you can see my point that the more you make, the more you pay. It varies by your filing status. These are the rates for active income. If you remember back to that slide of type of income, so these would be relevant for active income. This is income that shows up on a W-2, interest, and then this is a slide on capital gain tax rates, and these are relevant for passive. These are your passive rates on selling. Now, I mean, essentially, the earnings from investments can be active and passive in some respects, I guess, or subject to ordinary rates in the case of interest. But usually when we think of investments, we're thinking capital gain rates, because when we sell, we realize hopefully a gain, and those gains are subject to the capital gain rates. So let's just take a look at those. And currently, if you're a single filer or married filing separate and your taxable income is less than or equal to 47,025, the capital gain rate is 0. So having a 0 capital gain rate is kind of like the ultimate. Now, moving up, normally the rate that we see is 15%. And so essentially, if you're a single filer, to carry that forward, and your income is between 47,025 and 518,900, the rate is 15%. If you're over that 518,900, then you're subject to the 20% gain rate on the portion that exceeds the 15% gain rate. So, looking back at these ordinary rates, you can see, potentially, the capital gain rate is far more advantageous than the ordinary rates. And then when you think about Social Security and Medicare tax on top of that, which is 7.65%, the capital gain rates are really potentially substantially less, depending on your income. So now for the fun. So I took a little break and put in AI, create a picture of Uncle Sam, your partner in taxes, and this is what I came up with. And then I had a little more fun, and I said, now give him a casual look, and that's what AI came up with. And then I said, give him a party hat and a multi-layered cake, and this is what they came up with. So, I guess my hope is that, with these major decisions that you think about taxes, and sometimes, pictures you can't unsee. So, having a little fun, just sharing some versions of Uncle Sam. So now we've got time for questions and discussion. So with that, I'm going to stop sharing and open up the floor.
Hey, can you hear me?
I can.
Hey, great job. One of the things, that a lot of people always say is when you're talking to them and you tell them, that you're a tax preparer, is, well, my friend makes the same amount of money as I do and they get a refund. And that's one of the biggest things. And it's really hard for people to understand that, yeah, maybe they have the same type of income or they have the same AGI, each is 100,000, but somebody may have more capital gain, dividend income, that passive income that you're talking about, that's taxed at a lower rate than your all W-2 income. And people don't necessarily see that, but that's one of the things that, that we always get, a question on is, well, we made the same amount of income, and why are they getting a refund, and so that's something that, a lot of people, unless you really know, and like you explained, different types of income have different tax rates. That's just
for sure, Joanne. And then also, if someone overpaid their taxes,
right,
what are they going to get?
A refund. Why am I not getting a refund? Well, because they paid more money in.
Right.
It's a pretty basic thing, but people don't see that a lot. And I know I get that question a lot of times. And so it's good to explain that difference between the different, types of income.
Yeah, definitely. And sometimes, it's an afterthought, paying tax throughout the year, and then it comes time to figure up tax liability and you got to pay it all at once, you know, that's something that you never forget. And, you know, when a client is in a situation like that, I mean, there's always a reason, but we will help them implement profit first where they're saving for taxes. So, I mean, the worst thing when you have a tax bill is when you have a tax bill and there's no money to pay the
Right.
tax. So
Right.
profit first is one of the ways that we can help the business owner pay throughout the year and be prepared for whatever tax bill comes across. I mean, you know, you want them to be successful, and if the business is successful, there's going to be taxes to pay.
Right.
Thanks, Joanne. Yeah, Joanne's our tax director, so appreciate you joining us.
Yeah. The other
Anyone
question,
else? Any comments or
the other question
questions?
too, just like we talked about too on withholding. You know, a lot of people don't realize you can have withholding on your Social Security payments. You just have to fill out a W-4. I can't remember if it's a W-4. It's got a P maybe, I think, on it, and submit it to the Social Security office. And a lot of people don't realize, you know, how much tax actually is due if your Social Security is taxable. That's always something surprising to them. And they do allow withholding on it, which is something I suggest you do. So there is no surprise. And I think a lot of people are going to be surprised this year because the Social Security Fairness Act passed, and they're going to get a lump sum payment if you've, you know, worked for the government but had a job prior to working to the government. You know, there was some reduction in the amount of Social Security you got, and they're trying to right that wrong coming up. So some people may be seeing this big lump sum Social Security payment, and some of it's probably going to be taxable. So, but you can do withholding, which I suggest you do.
That's great. That's great, Joanne. Yeah, if you've never made estimated tax payments and you don't want to start.
Right.
Yeah, Tim, I just had one question. How does, if I have a rental property, how does that, you know, how is that accounted for from an income and tax perspective? If you could just.
Yeah. Rental property could, you know, in some respects, either be active or passive. It depends on what you do for the rental property. If you manage the property actively, you know, there's a good chance that that income is active, even though it's based on a piece of real estate that you've invested in. If you're an armchair real estate investor and you've got a management company, then, you know, most likely that is passive. You know, and further complicating things is when you've got someone who's a full-time real estate professional.
Yeah,
In
and then when
that
you sell it,
case,
right,
yeah.
that can be, I think a lot of us, you know, we take the depreciation and then, oops, we have to recapture when we sell and.
For sure. For sure. You're able to enjoy the deduction as the investment is going, but then at the end you don't have that offset.
Yeah, thanks.
Yeah, no, that's
Great,
good.
great information. Thank you.
Yeah, my pleasure. Thank you, Susie. Anyone else? We've got a couple more minutes, a minute more.
Good morning, Tim. It's Dan.
Hey, Dan.
Quick question. Is it more beneficial to have dividend income than interest income because of the tax rates? And would it be wise to focus in on companies that are sound fundamentally but pay dividends each year and grow their dividends because the tax rate would be less than interest income on a CD, like, for instance. Can you speak to that?
Yeah, no, it's a great point, Ed. Yeah, qualified dividends get that favorable capital gain rate, while interest is subject to those ordinary tax rates. Yeah, great point. All right, well, we're at time. It's 12:30. Thanks for spending some of your lunch with us, and look forward to seeing you again.